That office behind me, that's the Dominican IRS. And if you own property down here in the Dominican Republic as a foreigner, you need to know how they work and what you owe them. Today, I'm going to share everything you need to know about taxes in the Dominican Republic as a property owner, how taxes work depending on how you hold the property, and other considerations you need to have before you buy here. Let's dive in. Okay. Property tax bill paid. Now, before I get deep into this topic, I want to be clear. I'm not an attorney. I'm not an accountant. Like anything else on this channel, I share my own personal experiences and understanding, but you need to hire a professional for your situation and to verify what I'm saying is actually accurate, because there may be some things I'm misunderstanding. What I'm confident of is a term I used to use in my corporate days, which is, this should be directionally accurate. All right, let's deal with two common misconceptions about owning property and paying taxes down here. Number one is, I'm an American citizen. I don't owe taxes to DR. Wrong. If your property in the Dominican Republic produces income, then legally, you owe them taxes. Doesn't matter if you're not a resident, doesn't matter if you're not a citizen here, doesn't matter if you live full-time in the US with no other ties to DR. When you buy property here, you have to register with that office that I just went to, called the DGII. Translation, IRS of the Dominican Republic. I had to create an RNC number when I bought property here, which essentially is like a tax ID in the United States, so that they can then track my tax burden here, income or property. So from a legal standpoint, you're on the radar. Misconception number two, there's no property tax in the Dominican Republic. Not true. Here's how property taxes work here. You owe 1% of the value of the property that you own in taxes annually for every dollar over about 170,000 US dollars in value. Let me explain that more clearly. If you have a property worth $250,000, then you owe no taxes on the first $170,000. But you do owe 1% on the remaining $80,000, which in total is $800 for the year. Conversely, if you have a property worth 150 grand, again, you don't pay tax on the first 170,000, so therefore you owe zero taxes. And as a quick aside, there is something called CONFOTUR, which if you buy a property that is approved for CONFOTUR, you don't pay any property taxes for 15 years. And for the most part, CONFOTUR is only available on a new construction project that's approved by the government. It's not something you can just buy from somebody else for the most part. There's always exceptions, there's always nuance, but without making this too complicated, CONFOTUR would waive taxes, but we're gonna talk about if you don't own in CONFOTUR, which is most people. So you owe income tax, you owe property tax here in the Dominican Republic, depending on the situations I just talked about. But let's get deeper into it, because there's another 1% tax depending on how you decide to hold your property that most people know nothing about. All right, here's how we're going to break this down. I'm going to look at the three most common ways people might want to hold their property. Number one is in their own name. John Smith. I own it. It's mine. Number two is in a US LLC, which you can absolutely do. You can put your Dominican property directly in a US LLC. And number three is in something called an SRL, which is a Dominican LLC. These two things, virtually the same, but we'll go through it. Now again, in the interest of making it simple, we'll talk about these three ways of holding using this example. You own three $150,000 condos, $450,000 total. You rent all three of these long-term for $1,200 a month, which is $3,600 a month between the three. And that $3,600 a month pretty much equates to $43,000 in top-line revenue rent for the year. So let's talk about option one, owning it in your own name. For the purposes of Dominican income tax, when you own it in your own name, there are no write-offs. Again, somebody that understands things a little bit deeper could find a way, but pretty much no write-offs. That means you are taxed fully on the $43,000 worth of revenue. Can't write off management, can't write off maintenance, can't write off the Wi-Fi or the HOA. DR has a progressive tax for income taxes, so I'm going to use the average tax rate of being 22% when taxed personally. So if you take the $43,000 by 22%, that's about $9,500 a year that you would owe in income taxes if you hold it in your name. Now, some people might say, wait a minute, can't these taxes be, avoided? Is there really any good tracking down there? Yeah, tax evasion is real. I'm talking about what you legally owe. That's the point of the video. My understanding of it anyway. Again, consult a professional. So for income tax, my three properties making $43,000 a year, I'm taxed on the top line revenue, about $9,500, and then I pay expenses with the rest of the money. And then your property tax is 1% of the value of your portfolio above about $170,000. So 450 minus 170 is $280,000. You owe 1% of that, or $2,800 a year in addition. All right, now let's get into a US LLC. And be honest with you, a lot of this is going to be similar to an SRL. I'll explain a key difference with the SRL, but for a tax perspective, an entity is an entity. If you place your property in a US LLC, by law, it needs to be registered here in the country as an entity, just like an SRL would be. And just like an SRL, you can write off expenses before being taxed. Let's just say between all of the things that you can write off, which include trips down here to see your property, meeting expenses, all the things, you're able to show a 30% paper profit on that $43,000. So you're gonna take that $13,000 in profit, multiply it by the corporate tax rate, which is 27% in DR, and your taxes will be $3,500. But actually, you're going to pay $4,500. Huh? Here's that secret tax I talked about. When you hold your properties in an entity, an LLC or an SRL, there is a 1% asset tax for the value of the assets within that entity. In this case, we've got $450,000 worth of assets sitting in the entity. 1% of that is $4,500. There's no $170,000 thing. This isn't real estate. This is an asset tax. So if you had cars within the entity, jewelry, whatever was owned in that entity, the total value is taxed at 1%. But I also mentioned that your income tax is $3,500. Well, that gets wiped out because you're going to pay either the 1% asset tax, in this case $4,500, or the income tax, in this case $3,500, whichever one is more. So if the income tax went from $3,500 to $5,000, you would pay $5,000 in income tax and you would not pay this $4,500 asset tax. The asset tax acts as a tax floor. If income tax is above it, you pay that because it's higher. If income tax is below it, you pay the asset tax because it's higher. And there's no property tax on real estate held inside an entity. That's what the asset tax is for. So we just went, if you're holding it personally, from $9,500 in income tax plus the $2,800 in property tax, which is over $12,000 in total taxes, down to $4,500 in asset tax only. So that's a US LLC. Now, like I said, a Dominican SRL acts the exact same way. It's the same $4,500 tax burden in this example, which is the 1% asset tax. But there's two key differences with the SRL. Number one is the handling cost. Dominican tax law requires that you pretty much file a tax return monthly. So paying for a bookkeeper and an accountant to make sure everything is taken care of legally down here, it could add up to the tune of $3,000 to $4,000 per year in accounting expenses. So in this case, the LLC is a less expensive option. However, if the property is CONFOTUR, which if you remember wipes out all property taxes, that also wipes out the asset taxes in both the LLC and the SRL. And if you wanted to sell the property with CONFOTUR benefits to a new buyer, which is an advantage as a seller, you can do that if it's in an SRL. Can't do that in an LLC, can't do that if it's in your name. Can't transfer the benefits unless it's held in a Dominican entity. Now, that's all of what you owe to the Dominican Republic. If you're an American citizen, you still have to file all these taxes back in the good old US of A. But you'll avoid double tax when you use something called the FTC. This stands for Foreign Tax Credit. Essentially, whatever tax burden you would have in the United States is offset by the taxes that you paid in the Dominican Republic. So, if you paid $4,500 in taxes here, and the income tax you owe in the United States is $3,000 on the same property, then you're good in the US. You don't owe that tax because you already paid $4,500 in the DR, and that's more than the $3,000 you owe in the United States. If conversely you owed $6,000 in the United States, the foreign tax credit would offset $4,500, which you paid in the DR, so you owe $1,500 more in the US. Look, I laid all of this out in a newsletter, so it's really clear and you can see it all. If you go down the description, there's a link that goes right to it. You throw in your email address and you'll be able to read the article right away. But I got one more thing for you. What happens if you sell or you die? So the Dominican Republic, like the United States, has a capital gains law. This is where I think I'm right. It's 25% if it's sold as an individual, 27% if sold as an entity. So if you buy these properties for $450,000 and you sell them for $550,000, that $100,000 gain, you pay $25,000-ish to the Dominican government in capital gains taxes. Now in the US, you have a 15 to 20% cap gains tax. But again, my understanding is the foreign tax credit would allow you to offset that so you're not paying twice. And really in the end, you would owe all the capital gains taxes to the Dominican Republic and none to the United States because the percentage is higher here. And lastly, if you die, there is an estate tax in the Dominican Republic, which is 3%. So whatever the value of the assets are, 3% of that would be owed at the time of transfer of the property. In the US, there is a state tax, but I believe, and again, a financial planner would know better than me, at the level of asset that we're talking about here, $450K or so, if that's the entirety of the net worth, I don't believe any estate taxes apply federally. I don't know about state level, but just something to be aware of. Consult a professional. And that reminded me of something. It's ominous, isn't it? The tax authority when they're sitting over you like that. It's important to decide the structure of where you're going to hold the property when you acquire it. And here's why. Whenever you purchase a property and the name on the title transfers, there is a transfer tax in the Dominican Republic of 3%. So if you buy a $150,000 property, you have to pay $4,500 or 3% in transfer tax. That is waived if you're doing the CONFOTUR program. But again, we're not talking about that today. Now, if you decide to say, oh, you know what, I'll just put it in my name, and then later I'm going to transfer it to an LLC or an SRL, you're transferring the title to a new name transfer tax triggered. So if you're sitting there thinking, oh, it's in my name, maybe I want to send it over to an SRL, that's fine, but just know that you're going to pay the 3% transfer tax when that happens. So just summing this up real quick. If you hold the property personally, you're taxed on all of the revenue, no write-offs, at probably about 22%. It's a progressive tax scale. If you hold it in an LLC or an SRL, your income tax is after write-offs, so you'll pay much less in income tax. For property tax, if you're holding it in your own name, you're going to pay 1% of the value above $170,000. If you're holding it in an SRL or an LLC, you pay 1% of the total of the assets annually, or the income tax, whichever is higher. If you're holding it personally, you pay both. Now look, my Inner Circle community has an entire tax thread where we talk about this stuff in depth, share each other's experiences, knowledge, wisdom, and even have a suite of professionals that help and talk through these sorts of situations. You can go to jamiegruber.com or click the link below to join our Inner Circle and become part of an amazing community. And we even have a monthly attorney office hours where my attorney jumps on live on Zoom and answers people's questions. Would love to see you as part of that. Again, final disclaimer, please consult a tax professional and or attorney before taking any action on anything I talked about. I hope this helps you and gives you a little bit more tax information when owning a property abroad. Now, one more thing you might be thinking about is, well, what if I get a mortgage? How does that all work? Well, I did all of that here for you in this video. You can click on it, take a look, and it'll go step by step through every consideration I made in getting a mortgage myself. So check that out. I'll see you on the next one.